We have a panel supporting the green rush, the opportunity of ancillary cannabis companies. We had a few of these companies on earlier. I think I would wager to say it's the sector of the industry that's poised to grow the most, but I'd love to hear what these guys say. So coming on is Yeji Jesse Lee, who covers the cannabis and psychedelics industries at Insider. Is it Insider? It's Insider now, right?
Yeah, it's Insider now.
Very cool. Very cool. Well, Yeji, welcome. Thanks for being here.
Thanks, Patrick.
Of course. I'm going to go find a Shiba Inu icon to put up, but you guys have fun on the panel.
Thanks so much. Hi, everyone, and welcome to our panel. Today, we'll be discussing ancillary businesses within the cannabis industry. As the cannabis market has grown, so have the businesses supporting the cultivators and retail owners, and they vary widely in scope. While some supply design services, others work on branding and manufacturing, others they work on real estate. Now, some of these ancillary companies have grown into big businesses over the course of just a few years, and many raise millions of dollars in funding from private investors or go public to raise capital. They're only expected to grow bigger as they serve alongside these plant-touching cannabis companies. And to discuss all this, we have 4 panelists with us. And just, going off who's first on my screen, we have Gary Santo, president of Tilt Holdings, Sean Cradle, CEO of Pineapple Inc., and Bradley Natras, co-founder and CEO of Urban Grow. Now, before we get into the questions here, I'm just going to ask all of you guys to give a quick 10 to 20 second intro of yourselves. Gary, why don't you start us off?
Sure. So I'm president of Tilt Holdings. We specialize on the B2B side of supplying MSOs, LPs, and brands with both hardware, technology, flower, and distribution.
Great. Sean?
Hi, Sean, CEO of Pineapple Inc. We're the umbrella that owns the assets of Pineapple Express, statewide mobile dispensary in our 2 hours in California. We also have Pineapple Wellness, nationwide distribution of health and beauty CBD-only products. And we own the trademark THC, you can believe that. That is our in-house brand and our merchandise line.
Perfect. And Bradley, go ahead.
Thanks. Urban Grow is a horticulture company that engineers, designs, and integrates complex environmental equipment systems into controlled environment ag facilities. Predominantly, since inception 8 years ago, all of our business has been in the cannabis space, but we've expanded our reach to include food-focused controlled environment ag in the last quarter as well.
Great. Thank you, everyone. Now let's just jump into our first question here. I'm going to pose this to all of you guys just so we lay out some of the groundwork for this panel. And it's a pretty easy one, but why is there a need for cannabis-focused ancillary businesses? Why won't existing ancillary businesses, why won't they cut it? Whoever wants to jump in.
I'll jump in first because we're on the plant touching side. I think a lot of the traditional, ancillary businesses struggle with the regulatory regime, right? When you think about how a lot of these businesses would normally manage complex supply chains, there's a lot of centralization, and it really matters. Are you touching the plant or not touching the plant? So we have a hardware portion of our business, Jupiter, that doesn't touch the plant. We have a lot easier time, frankly, managing the distribution of those hardware items than, say, when we go to the plant touching side of our businesses and what we can provide and how we can provide it. So that's probably the first big reason that what makes us a lot more complex and difficult.
Speaking for Urban Grow, we have 49 employees, of which 2/3 of those are experts. We have a variety of engineers and horticulturists with experience growing multiple crops. And we've worked on over 300 facilities in the cannabis space. So this acquired expertise, it's of great value to our clients, and they need this knowledge to assist them in building high performance facilities so they can do what and focus on what they do best, grow plants and growing profits.
Yeah, I'd agree. I'd agree with both Gary and Bradley. In terms of Pineapple, just like Gary was saying, we did a reverse merger where we have our private company, Pineapple Ventures, that does not touch the plant. And this is something that, trying to tout on the lines of legality and federal regulations for folks that want to invest in cannabis but don't want to touch the plant. Maybe maybe they work for a firm that's in the stock market or something like that. We have a lot of investors that want to invest but cannot, and this allows them to do so. So with in terms of for our delivery service, which is got number 2 in LA, nice. And and for us, our vehicles, they are not attached to the plant. They're attached to the private company. So folks investing can still invest in direct delivery, but invest in maybe the fleet, expanding the fleet of vehicles, so things of that nature. So we thought of those things as well, just as you folks did. And I think that's a nice way to kind of bridge the gap for folks wanting to get in that cannot touch the plant.
Great, thank you guys. I think the next question I want to touch on is, we've all been involved in the cannabis industry for a few years now, and therefore we've seen the industry sort of balloon into what it is today. Can you talk to us a little bit about how you guys have grown over the past few years, what that's looked like, and especially what that's looked like when, capital was drying up and coming back, and, how have those ebbs and flows sort of impacted your business?
Well, I'll start on this one. And I'll share mine as related to growth and capitalization, because we have an exciting story, and it has not been easy. It's been far from easy. A lot of ups and downs, but we uplisted to the NASDAQ a few months ago, and it's really been a game changer and a life changer for Urban Grow. And it's all a chain of related events. We entered as an early entrant in the industry about 8 years ago. And our largest challenge ever since was always being undercapitalized. Great opportunity, great attitude, but just short on the gas and the rocket. And after focusing on achieving positive adjusted EBITDA results, we finished 2021 with $17 million in the second half of the year and 2 back-to-back positive quarters. And that really changed everything for us. We attracted a bank, which in turn led us to uplisting on the NASDAQ and completing a $62 million raise. And so with the funds, we now can execute on all of the great ideas that our leadership team has had over the years, but just didn't have the wherewithal to do it. So we're seizing this tremendous opportunity. We already have seen great results. We just announced Q1. It was $12 million in revenues and $500,000 positive adjusted EBITDA. So for us, the challenge has always been capitalization. Now that we have that, the doors are open for us to open our wings, live the dream.
Yeah, I can say, for Pineapple, the growth actually, it started, I would say, with COVID. And, with us in LA, we were already primed a year prior to the pandemic starting, delivering. So once, everything shut down, a lot of storefronts either had to close shop or they did not, even though the California allowed them provisional licenses or temporary licenses to deliver, they didn't have the logistics or even the know-how or wherewithal, as Bradley was saying, to go ahead and do that. So we were already primed to take that on, and we skyrocketed last April, double and triple sales throughout March, April, and May, and that conversion rate stayed. Because once people use the service, it's a very easy service. We take credit and debit, and we're there to you in under 2 hours. You can schedule your own delivery. So even without the pandemic, that's huge. And especially in LA. So once that happened, and then that actually, I did a campaign with the late. We lost our spokesperson, Tiny Lister, in December. He played Debo on the movie Friday, and a lot of other things, Fifth Element and all those things. But we actually did a campaign and we wanted to bring some joy to to people at home. So since last April was 420, it was a whole month basically for April 2020. Every Friday he delivered on his bicycle, kind of like a publisher's clearinghouse type of thing. And he would, people would enter the contest to win, and he would, knock on the door, and it'd be him. And it brought a lot of joy to people. TMZ picked it up twice in April and in May. And then that kind of caught the eyes of the celebrities in this town. And we've been able to catapult from that ever since. We've done a lot of pop-ups. We have a model where we call it Pineapple Pop-Ups. And we have movie nights, and, we have a lot. We'll do a big screen, and everyone can stay in their car, and we can technically deliver to their car. While they're enjoying the movie, along with other, food vendors and things of that nature. So we just did a lot of things like that all throughout the course of last year, and that seemed to get a nice buzz from folks. So that's how we've been able to continue to expand. We actually caught the eye of Fortune twice in 2019, and so we had a 2019 December issue. It was the investment guide to 2020. We were the only cannabis company in the centerfold there, so that was a huge push for us as well, along with us being public as well. And we're looking to get uplisted to the OTCQB. I would think in about 45 days if all goes on track.
I think for us, it was about the epiphany that a lot of cannabis companies have. So we went public on the CSE back in late 2018 with a lot of the same aspirations. Most of the cannabis companies came out there. We were going to do grow. We were going to do distribution. We were going to do production. We were going to help finance people. We were going to help software and services. We're going to do all this with a few $100 million. And I think what is a little bit different about cannabis and a lot of the industries I've worked in, such as life sciences or casino gaming and equipment or even financial services, is how much credit were given to those early movers and how much money flowed in and how much of it got burned because people didn't have, the key part that Bradley mentioned, they didn't have a plan, right? They just wanted to spend, and I'm just going to grow top line revenue because that's what allows me to go out and get more money. But around the middle of 2019, the market said, hey, there's another side of this. It's called profitability. It's called being able to fund yourself out of cash flow from operations, not just continue to dilute the shareholder or sell off your assets. So what we've seen is a migration in the industry where people with actual operational experience and with plans are starting to separate themselves. Now, for us, we've been really lucky in that we've had profitable businesses that even though we probably overextended ourselves in the early days and we had certainly a turnaround story of which we're now well through and into our growth trajectory again. But we've been funding ourselves out of cash flow from operation for about a year and a half now. We haven't borrowed money. We haven't done sale leasebacks. We haven't liquidated assets. We've really just trimmed down to the businesses that are making money and those that are not, and then growing those responsibly over time. So for us, it was a pretty big pivot. I mean, we were probably losing about $18 million in 2019, and now we had just under 17 million cash flow from operations and finished last year with about 17 million in positive EBITDA. So, getting people in their swim lanes, and I think realizing too that this vertical integration is somewhat of a unique moment in time, somewhat rented space, I think, in that you can't have companies do everything well, right? So you think about the distribution model Sean talks about, you can't do all those things. There's just no way. Very few companies do. They rely on specialists. And I think we're seeing that happening as the industry matures, and we're happy to be right there in the middle of it.
Now, one thing you guys mentioned, and I don't know if our audience knew this beforehand, you guys are all public companies, right? I feel like a lot of the attention so far on the cannabis space has been on plant-touching companies. And Gary, I know your company is also plant-touching as well, but it doesn't really seem like the average retail investor on Wall Street bets knows that much about the ancillary companies in the space. So I wanted to ask you guys, who are your investors? What's the profile of the type of person who's investing in your companies?
I mean, look, for us, it's been predominantly retail. Part of that's because, I think our share price and volume had dipped while we're doing the turnaround story. So institutions couldn't touch us, even though the story lined up beautifully with a growth story. But definitely, I think that's one of the challenges because people see the sexy margins that those MSOs who are plant touching are throwing off as they open up new stores. Now, what you're starting to see is a little bit of a slowing of the trajectory because now we're talking same store sales. So we're not opening up new markets. We're just expanding in the markets that are in right now. So as the world starts to come back a little bit and realize you can't do 50% growth quarter over quarter forever, I think now it looks a little different. I mean, our Jupiter division, so that's our hardware, non-plant touching for batteries and carts on the vaping business. The margins there, they're nothing to sneeze at. 25% gross margin, low to mid-teens on EBITDA margins. However, when you compare that to the explosive growth going on our plant touching business, where we have 50 to 60% margins top line and 30 to 40 bottom line, you can see why the retail investor tends to go to that spot first, right? They're looking for the 10 bagger on every single thing they invest in.
Well, for us early on when we listed on the OTCQX, it was predominantly retail at that point. There was a couple of institutional funds that participated, but now we have a great bank, and with the uplisting to the NASDAQ, we had over 50 funds, family offices, other institutions as well. So that's really expanded our reach. It's a different it's a different life, of course. But in my opinion, the success of some of our peers, Grow Generation and Hydrofarm, two other ancillary cannabis-related companies, they're succeeding. They're having a great run on the NASDAQ. And I think that clearly demonstrates that investors are ready. They're actively participating in our ancillary space. As for why maybe others would like to participate, maybe it's their personal comfort level with cannabis, or some of the steep fluctuations that have occurred with operators' equities over the last 1 to 3 years. But I think that I feel that companies with new investors that have not been invested in producers before, ancillary companies provide that safe first step into the industry with the picks and shovels.
We have everyone under the sun, basically. We were founder funded as well up until about a year and a half ago, when we started opening, retail fronts, and we're actually opening in about 45 days. 2 facilities are opening, one in Palm Springs, over here, and also on the corner of Hollywood and Vine. So if you can imagine that is going to be our flagship. So the fact that we have a private side and public side, we are totally vertical. We have over 14 vertical licenses in the state of California. We have everyone from celebrities to athletes to family offices, and I think we have one VC that invested in us here. So mainly because of that Hollywood and Vine location is a very big turnkey, especially when things pick up, and we're right on the Walk of Fame, so we're right in the tourist trap there, and there's no other dispensary in 4 square miles. So we have everyone under the sun. Basically, we have all the different dynamics.
The one thing I'd add before we move off this is, when you're going to be a public company, because a lot of these companies went public sort of through either a SPAC transaction or reverse takeover, they didn't really go through that IPO process, right? That got you out there doing the marketing, making the pitch, finding where the true resistance levels were in the market. And I think that did a bit of a disservice to a lot of the management teams out there, because they didn't do the typical blocking and tackling. I've been in this for about 25 years doing cap markets and investor relations. You've got to spend the time with the analysts. You've got to spend the time cultivating the different accounts out there. Not every person you sit in front of is going to take an order that day. And you just saw not a lot of emphasis put on that. There was probably more on the retail marketing side than you saw on let's build out the analyst bench. And I think that's something, I know we've been playing catch up on that. We just added another analyst ourselves. But it's one of those things that helps you migrate to that broader spectrum, like Sean's talking about. If you want to get those institutions, if you want to really get on people's radar screens, you've got to be working with banks and sales desks. So if you're not on the NASDAQ, like Brad's got the benefit of, you got to fight a little harder, but it's a pretty well-worn strategy. And if you've got a good business model, it's just doing that blocking and tackling.
Gary, you bring up a good point. When we first IPO'd on the OTC QX, we did a direct offering. Even worse, we didn't have any support whatsoever, no banking support. We didn't have any analyst coverage. Still today, right? Obtaining analyst coverage for Urban Grow today on the NASDAQ, it's a key focus of mine. We want to have that following, but reversing into a SPAC is one, but a direct offering is definitely a path I wouldn't have taken again.
We did it. We did it.
Did you? Yeah.
Yeah. We'll probably do it again.
Well, you have a phenomenal celebrity following, right? So that really benefits you, to get your brand out there, and I'm envious of that. Congratulations.
Thank you. I mean, I don't thank you for your envy, but I thank you for the kudos. But we didn't think that I knew I'd make it to the Snoop Dogg at one day. I just didn't think we'd do it so quickly, and that was really at the behest of us bringing on his manager. So we are actually the official delivery service to his compound, and actually we're building a lounge within his compound. Wow. So that's fun
busy
stuff.
Route.
Huh?
Busy route, huh?
Yeah.
All right, thank you guys. Next question is, over the past year, even over the past few months, we've seen state after state come online. How has this affected your business, if at all? And I think, this answer is going to vary a lot among you guys just because of the geographic areas you're in, but, would love to get your thoughts on this. Sean, I'm going to kick it over to you first.
Can you say that again, the question?
Sure. How has other states coming online affected your business? How is it going to affect your plans moving forward?
Actually, it's a very great thing for us. As I have a lot of people knocking on the door. As soon as that New York news hit, I had about 8 calls right away, wanting either pineapple or our THC line, because we do own the trademark THC and for Pineapple Express. And so some folks, they have a model, they have the money, they have maybe the licensing, but they don't have a brand. And people like this brand. So people are asking to, pretty much franchise the Pineapple Express name for dispensaries, and also the THC for our product. And so that's actually helping out tremendously for us. And I'm definitely already gearing up to go on a bunch of tours here in the summer.
Well, fantastic. Well, for us, it's had a significant effect, Yeji. Each state, to us, we treat really like its own country. That's why state rights are very important to Urban Grow as legalization approaches. When they award licenses for cultivation facilities, those facilities will be built. And so it's up to us to get in, engage with the client, perhaps even before they have a license, to ensure that we're there side by side with them when they're ready to make the decision to engineer, to design, to build out, to commission. Further, for our larger clients, the MSO clients, as they expand more aggressively to additional states, it really helps Urban Grow and benefits us as well, because they take us along for that ride. We deliver elite service levels, we do what we say, and therefore we're of value. As I started the conversation with today, they need that expertise that we bring. Finally, more mature states like Colorado, Illinois, as they sort of have consolidated and players have emerged that have those high performance facilities. Market competition provides an opportunity for us to engage our Grow Care program. It's a managed service platform. On the back end, once operational, we leverage those same experts to help train staff, remote monitor, audit facilities, provide facility optimization recommendations. And that's really growing as new states come on, and also existing states expand larger.
And I think for us, I think especially on the vaporization hardware side, we're already in 35 states and 15 countries. So as more states come online, it's just fertile ground to expand our existing relationships and then add a few new ones along the way. On the plant touching side, it's been interesting, whether it's a state going from medical to adult use or the surrounding states starting to make changes. I think it's also causing a lot of the West Coast brands who've been looking to come east. It's giving them more incentive to start making that move. It's been a challenge for them, frankly, because there's not a lot of opportunity. Either you sell yourself to an MSO or you partner with an MSO who, here on the East Coast, you have a limited footprint. So in Massachusetts, for example, no matter how big you want to be, you get 3 stores. So bringing your brand east and saying you get 3 stores in Massachusetts, how about it? I think that's part of an issue. So for us, we've started to look now more at some of those new markets and also look at some of those brands to bring them over and get a lot of that surrounding nexus. I mean, our dream would be to add some of those states like in New York and New Jersey and Connecticut. So we have that nice Northeast nexus for brands to come to and distribute across. So it's been very positively received, I think, across the board.
I think so far we've seen a lot of different states come online. Some I think that we weren't necessarily expecting over the past year. But I guess I want to ask you guys about the potential federal legalization that may be either on the horizon or maybe a lot further off than that. But how would federal legalization and, potentially interstate commerce really affect your businesses? How would you guys pivot if at all? How would you guys change? What would you need to sort of think about in order to compete with, I guess, mainstream businesses that haven't been involved with cannabis but might become your competitors now that cannabis is legal? Bradley, I'm going to kick this over to you first, and then we'll go around. And I think we have just 5 minutes left, so we'll give you guys each a minute and a half.
Perfect. As I touched on the last question, interstate commerce, significant value for urban grow. And there's many more facilities being built out. Without interstate commerce, what you'll see is a lot of super greenhouses, multi-hectare greenhouses like you saw up in Canada, where they didn't have the provincial rights early on. If I believe cannabis will be legalized, it's still 2 to 3 years out, at least in my opinion. We'll see a more aggressive demand for our Grow Care service program on the back end. And now with the raise, we have a $50 million cash position. So I'm focusing on scaling the business today. We have time. We have to make sure we're relevant. We have to make sure we're large enough to compete in a legalized U.S. marketplace. One example I'll finish with is where we've really, our sweet spot in controlled environment ag is indoor facilities, retrofits or new builds. We're now into food-focused vertical farms. But we have to evolve further for a legalized U.S., and that would include large-scale greenhouse controlled environment ag facilities as well.
I mean, for us, it's it would allow us to send product across state lines. So that would allow us to expand our grows here to be a lot bigger facilities, so we can make sure that our product is consistent across the country. Because if we license these things out, we'd have to have some sort of quality control, with these other facilities throughout these other states, to make sure that they're, everyone's getting the same. If you open a Coke in Florida and you open a can of Coke in Missouri, you should be tasting the same. And it's the same thing if we have, if we have somebody buys this in Arizona or LA, it should be the same kind of quality. So it would allow us to have a lot more control over our own product and less quality control management over other licensees. So obviously banking would be great. It's definitely a dance, definitely a huge dance with that. And also, being able to, get off of the OTC. And, that's for us being public, that's really the biggest thing. But at the same time, I do believe it'll happen within this administration. I think it needs to. And at the same time, I just want to let me build this up a little bit more. So when
I think a lot of people feel that way.
I can have a great package. So
I agree,
I'd like State Banking Act to go through immediately, and then I can wait, 3-4 years for the federal legalization.
Yeah, I think, I agree with Bradley and Sean, and I think it's going to take a bit. I do think it's important that the administration does it incrementally. If they try to do too large of a sweeping bill, it'll be too easy to get somebody to oppose it. I think the banking is the logical first step. But I mean, for Tilt, really, we're building ourselves so that we can thrive in the current regulatory environment, but really not have exposure in a fully legalized world. So we're being very intentional with how we're spending our dollars. And Sean, I completely agree with you that being able to have brand fidelity so that what you do in California, what you do in Massachusetts matches. So we're looking at brand partnerships. So we're not looking to just license, but work with them to make sure that when we roll brands out like Her Highness or other brands, that we're doing so in a manner that's true to the brand, that the product and the quality is the same. And while there might be regulatory reasons why it has to look a little different, it doesn't mean that it's a different experience altogether. So, I think for us, if you believe that cultivation gets commoditized and to a certain extent retail gets commoditized in a legalized world, we believe owning that specialty supply chain, which is sort of what the panel is based on, that's where we are, because that's, I think, still going to be a value add. It's still going to be necessary. So, we're building with that in mind as we deploy our dollars and look towards growth.
Great. If we had more time, I would have really wanted to ask you guys who you think your major competitors would be in a federally legalized market, but it looks like we are all out. Thank you guys so much for your time. This panel has been great, and have a great rest of your day.
Thanks, Gary. Sean,
I didn't want to
really appreciate it. That was great.
Yeah. Good time for me to come on. Thank you guys. Really
Best
appreciate
luck,
it.
everybody.
really wonderful discussion. Thank you so much for leading that for us, and look forward to seeing you guys all soon. I know Sean, we'll see you shortly back up here to present, but you guys have a great day.
Thanks, Patrick.
You too.
You too.
All right, take care.